Good morning to you all and welcome. From the video click, you see how important it is to hit the target, and this is today's topic. We'll be speaking about the quality growth boutique. Vontobel deploys different boutiques, and this is our historical boutique. We have here with us two pillars, Thomas Whitwer, who is the managing director, and he has been working for Vontobel since 1988. He is Swiss, he went to the United States, and he was charged to develop what the people had been trying to develop over a four-year period. And then we have Matthew Benkendorf. He's our Chief Investment Officer. He's the main manager of the emerging market global equity. He has been working for Vontobel since 1999. He started as an analyst, then a trader, and then the Chief Investment Officer position. We'll be tackling different important topics, such as the economic backdrop, what is before us, what is the economic outlook. Let's have a look at how concerns can develop in the future. And second, what are our solutions, how we behave to tackle these issues. And please remember, hit the target. Let's pay attention to what's surrounding us, but we aim at growing our capital. Let's see how our philosophy, our approach can match our main target, final target. And then we'll have a look at our portfolio positioning, current portfolio positioning, the various trades and strategies to better face this market. The possibility is there for you to ask questions. There will be a question and answer session, and at the end of the event, there is a quick lunch break. I don't want to steal any more time, and I invite on stage Mr. Matthew Benkendorf. The floor is yours.
All right, thanks. All right. Thank you all for coming today, and I know taking time out of your busy day. Hopefully we can provide you with some insight today, and ideally some solutions as well. As Matteo said, we think that keeping it straight, and being very straightforward, there is an easy solution to successful investing. That doesn't always mean the environment is easy, but there's certainly a very easy solution to delivering long-term sustainable investment returns and protecting client capital. That being said, as I'm going to walk through some economic slides, I think when you look at the environment today, we're probably facing, from an investment landscape perspective, one of the most difficult environments maybe we've ever seen. I'm not saying that to scare. I'm not saying that for any other reason, just to be aware. Let's keep it straight. Let's step back. Let's look honestly at the facts and assess, as is in life, there's always a good and a bad, right? But as investors, people tend sometimes to look only at the good. And we think you need to be realistic. You need to keep it straight. You need to be cautious always. We're investing client money to preserve and protect that capital. So let's look and assess the facts honestly, and then, unlike a politician today, I'm not here to just tell you the problems. I'm here to hopefully give you a solution, or at least a realistic solution to how to manage those problems. I think there's a lot of top-down things we're going to talk about, but I also don't want to be misleading in that we're not top-down at all from an investment perspective. And in actually managing investments from the bottom up is the best way to approach what is, as I described, a very difficult investment environment. And then lastly, in the presentation, we're going to talk about, as the solution, why quality, even as a style for those of you who know us, even as quality and growth have done well for so long, in the face of this difficult investment environment, they're still the best option. It isn't like the past where you need to hop around value, growth, market time, this, that. actually sticking with quality, we've spent the last 20 years proving that it works throughout all market cycles. So let's start to look at the truth of where we sit right now, very factually. First thing, recessions, right? In the US, who remembers a recession? It's been 10 years in the US since we've had a recession. A number of people have children who have never seen a recession, right? To keep things in perspective. Number two, why has that happened too? Why has it been so long? Let's look at the reality. Because monetary policy and central banks have been very unprecedented and extremely easy in accommodation, which is abnormal. Right? The last 10 years, while they've been good without a recession, the negative is they've been quite abnormal, right? And as well as we've had fiscal stimulation on top of that, right? We've had tax cuts in the US and other things on top of central bank activity. Point three I put in there just for a bit of highlight for those in Europe who deal with the issues every day of Brexit and leave, remain EU. It's the longest economic expansion since 1854 when Texas joined the United States. And I only put that in for humor in that Texas was the original Brexiter in the US. Texas is the US state that always wants to leave. Texas would be happy to have a referendum, right? So that's how unusual though this is. This is the longest economic expansion since then. And just to let you know that the sentiment within a union to leave is nothing new. This isn't new to this age. It's just a reoccurring theme over longer periods of time. Four, as we know, the obvious, right? I see a lot of experience in the room, for sure. A lot of experience managing client money responsibly with a fiduciary responsibility. But there's a lot of so-called experts in the sell side, analyzing businesses, making estimates, moving markets that haven't seen a recession either. They haven't lived through it, right? They don't have historical knowledge either. They don't have the appreciation of history that they need. So let's just be cognizant of that reality, right? I'm not here to pass judgment, but let's just continue to look at the reality, right? The next, decoupling, a recurring word for those who have been around in investing for a long period of time. Everybody's been waiting for this magical thing of decoupling. The developed markets from the emerging markets, different economies, The world will grow up, it will mature, things will decouple. You can be okay here while you're not okay over here. But as we've seen, the reality is the world has continued to get more and more coupled, right? It's fighting that tension of wanting to break, but the reality is, whether it's a slowdown in the emerging markets or the developed markets now, the world is more intertwined than it has been economically. And that's just the reality as much as people would want to think it isn't. The next point, which we're going to get into a little bit more deeply as we move on, is cyclical and structural growth. I think this is the key investment question of today. It's very hard for people to tell the difference now between what growth has been cyclical and what's been structural because you've been in such a long period of accommodative monetary policy and U.S. economic expansion, and that creates danger. Right? A lot of businesses that look like they're great might not be. They might just be riding an easy wave. And as Buffett famously said, when the tide goes out, you see who's swimming naked. And it's not until you get some recession, some geopolitical tension, that you start to get the ability even to see who's wearing a bathing suit and who isn't. But a lot of people think now everybody has this great structural growth story, technology, great structural growth story. But the last point to technology is a lot of business models we see right now as well, because of the rapid change over the last decade, they've never seen a recession either. So it's not just what's cyclical and structural of businesses that have been around, but a lot of the businesses we see today that are exciting, are new, people think they're great, Uber, Lyft, WeWork will come to the market. They've never seen recessions. How will they do? I'm not saying I know for sure, but I'm just saying we just don't know. The world is uncertain. As Charlie Munger said, Buffett's sidekick famously in the financial crisis, if you're not confused, you're not paying attention, right? And that's the reality that makes things difficult. But difficult, too, doesn't mean it has to be a down or a negative market. I'm not here to say I'm here saying the market's going to be down. I'm just saying we're back to normal in that it should be hard to make money. It should be hard to differentiate. There's no discernible easy tide for people to ride. And I think with the right investment approach, you're still fine. But that's just the reality if we look at this information. Also, to point 7, the recession indicators, and we'll look at them in a second. Classic right now, there's a lot of excuses of why we're not going to enter a recession. Right? You look at the facts that we'll look at, and you hear the classics, but this, but that, but this. Always when you hear that, you know that's a sign that you need to be a little more cautious and pay attention. So let's continue to look at where we sit today. Number 1, what I'm saying here is central banks, the reality is they're managing this gentle glide scope now, as we call it in flying. They're trying to land the plane, managing it perfectly, that speed and that timing, the direction. The most difficult part of the central banking job, it's the most thankless job in the world, right? People were unhappy with the economists at the Fed. They wanted a pragmatic Fed governor, and Jay Powell, he comes in, now they hate him, right? Your job as a central banker, stimulate the market, then stop, understimulate the market, slow the market, heat the market, cool the market, heat the market, cool the market. It's like the Greek mythology, you push the rock up the hill and the rock rolls down, right? But the reality is, and not to scare anybody, but statistically speaking, the most likely time a plane crashes is takeoff and landing. And it's a lot like monetary policy cycle, right? You're flying low and slow to the ground. And it's like that in the monetary cycle. Let's just acknowledge we're not in the heart of the cycle. We are not at the beginning. We are at the landing phase that we're trying to manage here. And just statistically speaking, that's where there's more likely to be a mistake. It's just the reality that we need to accept and manage around. I think when we talk about the EU and rates, also let's think about monetary policy in different places. So it's a glass half full, glass empty in some ways. In the European Union, as you know here, the good news is there are no interest rates, right? Monetary policy from a conventional sense is accommodative. Good news. Bad news is with that, what happens if things get worse? Right? Where is the firepower? Where is the fire hose? That's always been there traditionally. It's just not there. So let's just recognize that, right? The third point I think is important to what I said on the previous slide of the coupling of the world. Forever we lived in a world where if the US entered a recession, if growth slowed down in Europe, as they said, the US catches a cold, the emerging markets catch the flu, right? The demand pull was from the West. We live in a world now where, look who was the world savior in the financial crisis, right? China. Stimulate, pull demand, help drag the US to get it going out of the hole it was in. Now if the Chinese buy less cars, you feel it in Europe. You feel it in Germany. If the Chinese buy less luxury goods, you feel it in Italy. You feel it in France, right? So the demand pulls both ways now too. The world's more complicated. The world's more difficult. And Thomas is going to give you all a great word for this in a little while in his presentation, how you should describe this difficult world in one word. The last point is the most painful, almost. I mean, you lived through some painful politics, I think, here in Italy. You have a European election this weekend, but Brexit, how long are we going to have to talk about Brexit? Brexit, it's going to happen, not going to happen, delay, right? But the reality is it hasn't happened yet, right? No one, I think, other than Theresa May wants it to happen any faster now at this point, but we still haven't even seen that. We saw a vote, we saw a reaction, we saw a market recovery, and it drags on and on and on. But at some point, it is going to happen, we think. Probably. There, I can't even say with certainty, but with high certainty. Eventually it's there. Now it's October, or whatever the new deadline is exactly. But the point is we just haven't even, we've talked a lot about it. We've all thought a lot about it. We've worried about it. We've not worried about it, but we haven't even seen it yet. We are going to have to face that yet, that reality of what eventually does happen. So what are we looking around for? Key one, what you're seeing right now is this new thing that if central banks aren't easing, they're tightening somehow. So by not stimulating, they're tightening. That's it. It's not good enough to not be easing anymore. If you see the market behavior, the market is hooked on heroin. You saw it in the US in the fourth quarter. The markets came under pressure. The Fed had to signal and indicate no more rate, it was enough, no more rate rises. We can't take it, right? And the market's pushing now quickly, not just no more rate rises, the market estimates want a rate cut by the end of this year because the current status quo of just not tightening further isn't enough. The market has become addicted to this monetary policy stimulus and direction. And we see that with risk assets flowing back and forth. Finally, the point, before I move on a little more quickly, is the trade deal, the other. We hear enough about the Brexit. Now you've been subjected, all of us, to the trade deal, the China trade deal. When will it happen? It'll happen or it won't happen. But the point is, it's not about the trade deal now, right? Maybe if it lasted a week, maybe if it lasted 2 weeks, a month. But this isn't something I wake up every day waiting for, thinking the world's going back to the way it was. I think the point is the cat's out of the bag, as they say. It's not about the trade deal. It's about the relationships are changed, permanently altered, adversarial, confrontational. There's no real solution. The longer it goes on, the harder that confrontation will get. So while everybody's just waiting for this magical moment of a trade deal, and if it happens tomorrow, it's not going to matter, in my opinion, and looking at the reality, if we look at what's going on, what would need to be settled and stay settled for tension to ease again. And I think that's a hard reality for people to live with. This isn't a political issue. And if you look at contentious politics in the US, there is one thing right now that Republicans and Democrats can agree on. And it's not even that the sky is blue. They would disagree on that, right? But one thing they can agree on is China. The question is just who can be harder now from a political, tactical sense on China, right? And we know politics complicates everything, right? So in the US, you look at, we have a mess right now in our own politics, but there's one thing that the politicians agree on, which isn't going away with the trade deal. It's China, intellectual property, China's role in the world, the democratic or lack of democratic system, human rights, all these things are out now. And there's no political posture in the US to ease up, right? That's a big, big change. It was consensus forever, a fairly uniform policy, globalization, allow it happening, and that's big. Now, before I flip the next slide, I have a question for you. With all this being said, well, fortunately, we're a sophisticated industry, we have economists, everybody's wondering when the recession is coming, as I mentioned earlier. If you look at economists' predictions and take the IMF, over the last 25 years, the IMF, a good group of economists, not saying anything negative, great group, talented economists, well-trained, they follow the world economies, make projections. Over the last 25 years, how many times, looking 1 year out, has the IMF been able to correctly predict a recession coming? What do you think? 16%, 1/6, right? Just looking 12 months out, from now till next May, tell me, looking at the data. And I just say this not because, as I said, the IMF isn't smart, it's just an impossible task. And we need to accept that. The question is how we manage it as investors, but let's accept the reality. And let's also be cautious when everybody now gets on TV in the morning and CNBC or Bloomberg and says, don't worry, we don't see any recession. I'm just saying they don't know. And no one ever sees it coming anyway. So let's just at least be prepared, right? As the saying goes with things, better to have it and not need it than need it and not have it. As in investing, let's just make sure we're prepared because let's accept that no one will be able to predict what's coming. The other scary thing about this that people, I think, underappreciate. It's not just about the recession. It's not just about predicting GDP growth, which leads conventionally to determining a recession after 2 quarters. People underappreciate that most of the way the financial world works on Wall Street, in the sell side, all the big banks, is the economists are the smart ones who make the projections, and all the people following the company follow those projections. It trickles down. In life, one thing often trickles down, right? So all these companies, all the analysts following these companies, they follow a view. So often things rest on one precipice. When that changes, it breaks the predictability of these businesses. Getting back to this question, what's cyclical and what's structural? A lot of people don't see the cyclicality because even number one, not only do they not understand the business, they're looking at a projection of growth, so they're not worried about it. And it's not incorporated into their estimates of what the business will do. It's also part of the reality that we're in. I promise I'm not going to be so downbeat and depressive, but this is the facts, right? It's good. I think, as I said, difficult doesn't mean we can't make money, we can't do well, but let's just acknowledge, the landscape that we're in right now. And as I said, provide you a solution. Here's some good news, if I give you some good news, a little bit. Right? The good news is historically, when there are recessions, there aren't typically big blow-ups. What we saw near term in the financial crisis in the US is rare, quite rare actually. So that's the good news. While we don't have to predict when the recession is coming, I think from our investment standpoint, and the world won't be able to do it by and large, the good news is usually recessions are shallow. People will be scared when they come, but they will be shallow. The bad news, as I give you the glass half full and glass empty, is previously we always had a lot more monetary policy firepower stored up, which really helps cushion these falls, right? Which is also why you hear a lot of new words being invented now. Modern monetary theory, right? We're already, from a central banking perspective, trying to think of other ways because we know the reality is interest rates play a very important role cushioning the fall, preventing blow-ups. And now we might need some unconventional or new tools, and that leads to the landscape. We just don't know the shape of monetary policy the next time around. It won't just be interest rates. Why? Because interest rates are already low or zero. That's just reality. It's not a prediction. But let's understand that landscape. By the way, this is the slowest I've ever talked in Italian. I hope the translator isn't 3 slides behind. We're doing pretty good here so far. I'm pretty restrained today. China, I'm going to cover the 2 big economies really quickly, and then we're going to start to give you the solutions. As I said, I'm not here as a politician to tell you your problems and say, trust me. We're going to give you visibility into what the solutions are to navigating an uncertain environment or difficult environment. China, the big elephant of the economy, we'll treat that first. Right? So what's the state of play in China right now? China, as you can see, everybody talks about debt, right? And we always obviously talk about the obvious. People recognize this, just what do you do about it? Or how do you react to it? China, private sector debt, right? The good news is, or the bad news is rather, it's right up here, with Italy and the US and us. This isn't a developed market. This is an emerging market, right? The GDP per capita in China is similar to the Dominican Republic, an island in the Caribbean of the US, right? So it's not, we are managing the debt, not a problem. The problem is when your GDP per capita is low and you're a developing economy carrying the same burden. That's a bit of a problem, right? It leads to opportunity. Doesn't mean it's an impossible problem, but it makes it more difficult to navigate. The level of debt they've taken on is unprecedented. No one at this level of GDP per capita has ever reached this level of leverage. It's just different. It's new this time. It's the reality when we look at China. So the good news is China has a lot of power. It's a command control economy. It can do things that other countries can't as a communist country. But the bad news is it's already pulled a whole lot of levers to get this far down the road. So where will their fire hose be, if we run into further trouble? Here's the US. On the other flip side, I give you this slide just to show you and remind you too. The US, at least, which is probably being longer in the cycle, closer, right, to a recession if and when it happens. China, is re-stimulating now. The US being this question of where we are in a cycle. I put this in there for that reason, that the good news also, as with the earlier slide with the US, specifically is often recessions have been shallow in the US, right? That's the definite good news. Still, there's a lot of economic flexibility. We hear this funny debate now of capitalism and socialism, but still the free market, independent central banks, this still seems to work well historically, right? And I think this actually is what will create an opportunity, particularly in the US, where you're starting at least at a higher base of interest rates, at least with a more flexible relative economy, right, where things can clear more healthily. This can create a real opportunity in the US when the recession comes. As investors like Buffett, we want stocks to be down. We don't want stocks to be up. In the long run, we want them to be up, but a lot of the time we actually want them to be down because we're saving. And when we're saving, we want to buy low. So this could create a great opportunity. We've had a great long run in the markets, and maybe it's time to reload, right? Maybe it's time to re-up. So this could be coming, as a lot of people are afraid of it, actually, it's something we should welcome. And the good news is we should take some comfort that it's rare for there to be a collapse. But given where everybody thinks what happens in an economic slowdown, it could really create an opportunity. People will see the onset of a recession and think depression. So we really could get a great opportunity if we're paying attention. Last couple indicators here, right? This is where I say the buts. Everybody's looking at the indicators, they say but. This is the Fed model. It's been a rather successful model historically, as you can see. Its predictability, these charts are the recessions, right? Here's where we are in the current Fed model, right? I mean, people see, I see this isn't hidden, this isn't our chart, but people see this and say, don't worry. Don't worry. And I'm not saying it's going to play out again, I'm just saying, okay, but let's be careful. Let's at least acknowledge this as a reality, and then let's think deeply about this question. We're going to talk about what's cyclical, what's structural, because if you don't acknowledge this reality and think about what's cyclical and structural, you're leaving yourself really exposed to a lot of unnecessary risk, and quality is a very powerful way you can avoid that risk. Lastly, a bit of concern on emerging markets, right? Because we think, well, emerging markets, which is coming relative to the developed markets, more out of a cycle. The cycle bottom 2016, emerging markets, a few can still stimulate or actually lowering interest rates like India. Emerging markets, besides the risks I said in China, have the opportunity to consume more, to grow. Certainly, that's common sense, right? And the balance here as well, if things slow down in developed markets, emerging markets will be fine. As I said, things are a little more coupled than people appreciate. But what this shows you is historically, U.S. interest rate rises naturally lead to growth slowdown, estimates of growth slowdown and growth slowdown subsequent. That's where we are in the cycle, right? Interest rates came up in the U.S. The good news is the growth estimate, as interest rates came up in the U.S., right, the growth estimates came down in the U.S. That's healthy. These people thinking some common sense. Growth should slow because of this. It always happens and it should happen. The problem I'm just pointing out is people are not putting that connection together with emerging markets yet. The same thing has typically happened in emerging markets. Interest rates come up, growth slows down, but for some reason this time, people just don't think it's going to happen. What the issue is, as in Wall Street, just people haven't caught up yet to it, right? So let's just be aware of this too. Emerging markets can be a good place to be, but just blindly going into emerging markets with the index, you're buying all these estimates, right? With most active managers, you're just buying all these estimates, which probably aren't conservative enough, and the businesses aren't good enough. And so this is also part of the landscape to acknowledge. Last slide, and then we'll start to cheer you up with some of the solutions a little bit more. Non-performing debt, back to this emerging market question. Also, people look, I've mentioned the growth estimates in emerging markets. The good news is in the developed markets, some good news is the non-performing loan situation has really vastly improved, right? So banks, you question some of the issues banks still face, but at least you can see non-performing loans across advanced economies have improved. The bad news is in emerging markets, and this number is really pulled up by a country like China, right, with some leverage still in the system, the non-performing loan situation still needs help, right? It still needs improvement. So what happens, right? At least it's good to enter a recession, at least here, because there'll be normalization upwards. What do you do when you're here already and you haven't improved, right? That's just the reality. So with all that being said, just to give you an honest, straight shooting lay of the landscape. Glass half full, glass half empty, but let's acknowledge the world is more difficult right now. And now let's start to provide you with some solutions to that. Some very easy, common sense, understandable solutions. Thomas will start that introduction. And then I'll come back around and start to take those solutions and show you the application of them in the portfolio and how they play out in your actual portfolio. Right? Thanks.
Thank you, Matt, and good morning, everyone. Pleased to be here in sunny Milano. As Matt said, risks are rising in the marketplace, and what I would like to do in the next few minutes, introduce you to a time-tested team and introduce you to the time-tested investment philosophy and approach before we go to the solutions part. First and foremost, I would like to talk about the Quality Growth Boutique, our culture, who we are and what our mission is. The Quality Growth Boutique used to be Vontobel Asset Management, Inc. in New York. Now that Vontobel has grown to a multi-boutique firm, we are the Quality Growth Boutique. But over the last 30 years, we really haven't changed that much in that our culture has been investment-led, number one, and number two, clients come first. And what really makes me go to work happy every morning is the fact that I know that we can take care of our clients' assets. And number two, we can take care of it in our high-quality growth at sensible price investment approach. And if I had to put our mission at our firm in one phrase, it's really about protecting our clients' present and through our investment style, enable their future. Now, we were founded in 1984. We have about 32 billion in assets under management. We run 6 long-only equity strategies. That's all we do. And last but not least, we have 70 employees at your disposal. The investment team in New York is long tenured and experienced. We have 32 investment professionals at our firm, so we have a deep bench of investment analysts, be they investigative journalists, be they classical research analysts. They have various backgrounds. Some of them were born and raised in developed markets around the world, others in emerging markets around the world, and we conduct our research from 3 locations, 2 in the US, New York and Fort Lauderdale, as well as our outpost in Hong Kong. We have 7 portfolio managers, so we have a deep bench of portfolio managers that manage our 6 investment strategies. I said we have an experienced investment team. That translates into 24 years average industry experience, and on top of that, that team has been together on average 10 years at Vontobel. So I can tell you that we can give you 300 plus years of investment experience when we manage your portfolios. So what can you expect when investing with the Quality Growth Boutique? I think the first and foremost thing is alignment of interest. We need to know what our clients want, and we need to tell our clients what we can provide. Or in other words, we provide clarity and you have choice. You can say, yeah, that's for me, or it's not. So what are the 3 objectives that we have? Number one, it's capital growth. We invest in an asset class like stocks to get the long-term benefits of outperformance relative to other asset classes. Number 2, it's about losing less in down markets. We believe if you outperform over time, you have to make sure that you provide better downside protection when markets go down. In order to achieve our ultimate objective, which is outperformance over a full market cycle, which means bottom, peak, bottom, with less than market risk. Now, how have we done? This is our global equity strategy. We show you the performance here net to our clients in our SICA funds. And what we show you is that if you had invested 10 years ago, $10,000 in our strategy in the global equity fund, you would have today about $21,000 great performance, and on top of that, you will see that we would have outperformed the benchmark by a wide margin. What's more important is we had 4 downturns during those 10 years. And in each of those downturns, we protected the capital that you entrusted to us better than the index investment. So that is really how we outperform, by participating in up markets, protecting in down markets. That gives you the desired result of outperformance over a full market cycle. Now, when you look at that performance, of course, you say, oh, wow, this is really great. I should have all my money in that global equity fund. Our presentation says, keep it straight. So I want to keep it straight here as well. And of course, outperformance comes at a certain price. Our portfolios don't look like the index. They don't behave like the index. So it's very important for you to have a long-term perspective. And I want to show you how that translates. If you look at your portfolio on a 3-month rolling period, so you always look back 3 months and see how you have done relative to the benchmark, our global equity fund is quite volatile relative to the benchmark. So there were a couple of periods where we underperformed by a wide margin, and most probably you as an investor would have gotten nervous. But it's very important that you have a long or longer-term perspective. So let's look at this from a 3-year rolling period point of view. You see, all of a sudden, the blue line tends to be above the 0 line, so we provided you consistently with an outperformance, maybe with the exception of the early 2000s, and that is really a period when we came out from the internet bubble, and as a high-quality manager, we did not participate in that. The price we paid is short-term underperformance relative to the market. If you look at it from a 5-year rolling period, then of course it looks much, much more consistent. So it's very important when you invest in an active, high-conviction investment style that you also have the necessary time horizon to reap the benefit of such an investment style. I want to give you an example in point. Our emerging markets equity strategy was out of favor recently. We had a similar period here in the 2006-2007 period. And when you look at that and you look at the longer-term performance after those periods when the 3-year or even the 5-year performance went under the 0 line, you see that was a great opportunity to invest. And I want to introduce you to the cycle of market emotions. I'm sure you as investment professionals have been exposed to it or at least have experienced it as well. And it's very important to just remind ourselves, when you buy an investment and you put your money in it, you do that on optimism. When the investment starts to do well, you get excited or even euphoric. You said, oh, wow, I'm really good. I made the right choice. But that's exactly the time when your asset is at the point of maximum financial risk. What usually happens is those returns roll over. First phase, when you lose a little bit, you're just in denial, doesn't matter. I'm in it for the long term. It goes down further. You start to be fearful, then you panic, and you get despondent, and then usually you decide to sell. Exactly at the time when your financial asset is at the maximum point of financial opportunity. So let's keep that in mind. And what we do at Vontobel, or what we're trying to do on a day-in, day-out basis, is really separate the emotional value from an investment from the actual or fundamental value of the investment. Let's talk about market timing. We always, want to pull the trigger, and I have news for you, or maybe not. Market timing is hazardous to your wealth. Let's take the benchmark MSCI index. Let's look at the 10-year performance. Over 10 years, the asset class provided 40%. If you missed the 5 best days in those 10 years, and you just the day before you decide, okay, I had enough, I'm going to sell it, your performance would have been negative. So timing can be very dangerous to your long-term wealth. So that's the benchmark. Let's look what would have happened if you were to time our quality growth emerging markets portfolio over 10 years. We provided 80% return. So good outperformance relative to the benchmark. If you lose, or if you time the 5 best days, what you're going to get is a return of 25% or an underperformance relative to the market. So the message here is very clear. You have to have a strategic allocation to an asset class that you want to be exposed to, and to an asset manager or an investment style that you want to be exposed to, and give them time to do what the style and the manager is supposed to do. Good. Let's spend the next few minutes on our investment approach. We call ourselves a high-quality growth at a sensible price manager. And our investment philosophy is very simple. We believe if a company does well from an earnings perspective, the stock price will reflect that in the long run. And here we have the proof. This is a chart of the MSCI All Country World Index. And what we show you on a sector basis is the correlation of earnings growth or EPS growth versus stock price appreciation. And what you see is there is a high correlation between the two. And for our high-quality investment style, that means a couple of things, and I listed them over to the left side. Number one, we concentrate on companies, we concentrate on bottom-up research. It's about the companies that make us win over time. It's not about the big picture or the macro issues. We only invest in high-quality businesses because those are the businesses that grow faster in a more consistent way and get us from point A to B in a more secure way. We have a high conviction portfolio, which means we're fairly concentrated because not every company is a quality company. Quality companies are rare, and therefore we concentrate our portfolios. We are benchmark unconstrained, and last but not least, we have a longer-term view. When we invest, we have a time horizon of 3 to 5 years. Now, what's a quality company? We list the attributes here on the left-hand side, and it's basically 4. We're looking for companies with a dominant market position. We look for companies that are predictable, sustainable in their earnings growth, and we look for steady demand and pricing power for the company. Last but not least, we also look at the balance sheet strength of a company. Of course, we like to buy into the highest quality. What we end up with is listed here on the right-hand side. We tend to invest in large mega-cap companies that show a very high return on equity relative to the market. We show also an earnings growth rate that's superior to the market, but we also show you that we are willing to pay up for those kind of investments because we believe quality has its price, and that price is higher than the average company. When it comes to growth, we're not just a high growth manager. We really look at growth in various spectrums, and we list them here. We look at mispriced growth, which are companies that, for whatever reason, are mispriced because usually of emotional reasons in the marketplace, and that's a good opportunity for us to buy that kind of growth. We also have defensive growth companies. They protect us on the downside. Think Unilever, think Nestle, think United Health Group that Matt is going to talk about today. And then we also participate in the long-term secular growth stories where you have secular growth at a fairly high or above average rate. Think MasterCard, Visa, Google, Alibaba. Okay, let's put it all together in this chart where we really show you the benefits of our investment style, at least for those that have the patience to be invested for the long run. We look at our portfolio on the left-hand side and measure the EPS of our portfolio relative to the EPS of the benchmark. And what you get here in black are the Vontobel EPS numbers versus the blue, which are the numbers for the index. Number one, the black bars are always positive. That means over the last 10 years, our portfolio had positive returns relative to the prior year in every given year. That's the consistency and predictability that we're looking for. Let's compare that to the benchmark index. There, the variety of returns was much, much more cyclical. So the range of quality is lower or not as wide as the range for the regular, more cyclical index. And on the right-hand side, you really see what happens to the EPS growth of our portfolio in black over time. It compounds much, much faster than the EPS growth that's less consistent for the index. And what that translates into at the end of the day for you, the investor, is from a performance point of view, the index ends up here. We were able to beat the index by a nice margin because the underlying businesses gave us more performance and more stability. Last but not least, let's talk about our risk management. Risk is in the businesses that we invest in. We also define risk as the risk of permanent loss of capital for our clients, and that's clearly what we try to avoid. Therefore, risk management has to be ingrained in the investment approach, and we secure it in 4 different ways. Number one, we analyze companies. We only concentrate on the best high-quality companies, and therefore, we eliminate avoidable losses. We diversify across the growth spectrum that I explained: mispriced growth, defensive growth, secular growth. We also monitor it with our team of 32 analysts, be it from an investigative journalist point of view, where we look at sector risk, regulatory risk, or at company risk through our research analysts. And last but not least, when we buy those better companies, yes, we pay a higher price, but we do not pay any price for those companies. In summary, number one, we have an investment-led culture at the Quality Growth Boutique in New York. Number two, we are bottom-up investors. We concentrate on company analysis through our team. Number three, we have a longer-term view that differentiates us relative to our competitors in the market. And number four, our team is long-tenured, experienced, and has been at our firm for a considerable period of time. Good. I want to go back now to what Matt was talking about when he introduced the big picture that we're confronted with today. And he clearly indicated to all of us that risks in the markets are rising. I want to introduce you to the term VUCA. And VUCA is a term that was introduced to us in 1989 by the US military, and it was after the Cold War came to an end. The Cold War was an easy time from a political risk point of view because there was good, the Soviet Union and its allies, and there was bad. It's the other way around. The good one, US, the bad one, the Soviet Union and its allies. And as the wall came down, all of a sudden, you couldn't really say what was good, was bad. There was something in between. So all of a sudden, the world became a little bit more complicated. And therefore, they started with the term, we're living in a VUCA world. And VUCA stands for volatility. It is a more volatile world. U stands for uncertainty, and C stands for complexity, and A stands for ambiguity. So therefore, clearly the world has changed, and decision-making in this new world is more complicated than it used to be. And I believe that in portfolio management, we face similar issues. And we believe that an active manager with a clear investment philosophy and following that investment philosophy is at an advantage, because we can use contextual sensitivity to the matters that we're confronted with. When you have a more mechanical, quantitative approach, it's more difficult to adapt to the ever-changing investment world. Now I would like to reintroduce you to Matt and our portfolio positioning.
Great. So with the rest of our time here, as Thomas has laid out very clearly for you, the mechanics of our investment philosophy and how we carry out things, who carries them out, I want to give you the chance here to get a little bit more of the sense of some philosophical aspects that you wouldn't normally be able to see on a screen or pick up on, a little bit more of the essence of how we apply this, how we think, what's our mindset with this basic process and understandable process. And then I want to give you a quick snapshot of what that looks like in manifestation in a portfolio sense, in application. This, as I mentioned earlier, I think is the key issue. I mentioned the lay of the landscape, but I think as an investor with that landscape, this is going to be one of the critical issues or problems that people are going to get right or wrong based on the lay of the land. It's what's cyclical growth and what's structural growth. As I mentioned earlier, it hasn't mattered for a while, particularly in the US, because the cycle's been long and enduring. But as I said, when the tide goes out, we'll see who's swimming naked. And at the Quality Growth Boutique, with the philosophy that Thomas has laid out in that process, this is the heart of how we get to what we do. We distill and eliminate the cyclical and low quality, and we focus on the structural and the high quality to be able to navigate the environment. Philosophically, with that process, what are we thinking? What am I thinking? What is my team thinking? What are we thinking day to day? Just to remind you, number one, protect capital. Our net worth is invested in these clients alongside our clients in these products. Number two, we need to grow the capital too. Right? We're investing. Preserve the capital, grow the capital. But the third is the important philosophical consideration, where most people go wrong, that we're very sensitive to. Most people sacrifice one to get to two at some point. Nobody wants to lose money. How they end up losing money is when they reach for number two. You end up having to trade away number one, and we aren't willing to make that trade-off, and the way we do it is this structural versus cyclical. At certain points in the cycle, you can get better growth. At certain points in time, you can get better growth, but it's probably not enduring. It's either cyclical or temporary for other structural reasons. We are looking for that real structural enduring growth that allows us to not sacrifice our principles, and as they say, have our cake and eat it too. We can have both, as long as we're mindful of those two. As we've introduced here, we do it through intentionally more stable earnings. How we define quality. Quality is predictability, and I'm going to show you philosophically what that looks like in a second. I'm going to show you also fundamentals matter more than quantitative measures. Quantitative measures can be very misleading. We have, as an investing community and as people, often a false sense of comfort with precision. And we always want to measure things precisely, but we often miss the bigger picture by doing that, by trying to over-measure something. And quantitative statistics sometimes do that, right? They have limitations. As we say, it's like not seeing the forest for the trees at the end of the day, right? Last, where do we add value then? So everything, if I've said so far, you can understand and agree with. So at the Quality Growth Boutique, where do we add value? We add value in our consistency, in our discipline, and our willingness to look different over time. As Thomas showed you the rolling historic returns, we have to be willing to underperform to outperform. And that's what most people don't do. And that's key to that is separating what we call business risk from investing risk. It's a business risk to us to underperform. Most investment managers give their clients that business risk. They get the investment risk and the business risk by giving them the benchmark or something looks like the benchmark, so they never look that different. And the money is less likely to leave. As Thomas said, there is a price to pay for what we do. Nothing is free. As I joked earlier, there's no such thing as a free lunch in life. Even today, you have to sit here and listen to us for the lunch, right? There's no such thing. Always be cautious when something seems free, because there's a price, right? Hopefully it hasn't been that costly, and we can pay you in return, right, with our results. But that's the key, right? You have to be willing to underperform to outperform. But most people give their clients that business and investment risk. We said long ago with our founding fathers in New York, we'll take the business risk. We'll be willing to take that business risk because it's the only way to deliver lower absolute real risk to our clients. And that means we're going to have to look different, but be consistent, looking different. We stick to what we own, we stick to stable, predictable companies, and we let them do the heavy lifting for us. So let's look at this one aspect I said where quantitative statistics can be a little bit misleading. Over the long term, they might get things right, but inflection points, as we know, are very dangerous, right? This is one classic measure of risk in investing, standard deviation. And over the long term, it gets it right. Over the long term, our standard deviation realized it gets it right, that we are lower risk. But this hyper-focus of precision right now, and often the sensitivity can mislead people, right? So let's look historically periods where our standard deviation is fairly similar to the benchmark, although look at our portfolios, looked quite different. We owned a lot of what wasn't fundamentally risky. The index owned a lot of what was fundamentally risky, but the quantitative statistics just didn't bring that up until you had a recession, right? Then the portfolio didn't change. We didn't change the portfolio. We didn't make up. We didn't change our holdings. The quantitative statistics had to realize that, right? So my point here is you can't fall with a false sense of comfort in quantitative. Philosophically, we're always focused on the real risk. And we're not going to let a quant statistics run our portfolio. We're going to look at our holdings. What are the fundamental risks to our businesses? That's what matters, not the stock. What does our business do, and where does it do it? What are the competitive advantages to what it does? What drives it growth? How is it structural? How is it not cyclical? That's what real risk is. If you get that right, eventually then the statistics follow. But don't lead with statistics. And you're seeing, I think, as I've laid the landscape, maybe a similar dynamic today, right? Here, we don't look that much less risky than the benchmark, but look at our holdings. We are quite different than the benchmark. This is an impossibility, what this number is telling you. We could be right, we could be wrong, but we're not the same. That's for sure. So this is where I think you need to be a little bit careful, certainly with the cyclical and structural issue. The second part, right, emotion, right, and being consistent. This is what the market looks. This is the index, and this is ourselves. This is over this very short period of time we saw towards the end of last year into this year, right? When people get nervous, this is the index, a broad swath of lower average quality companies, some good companies too. Sentiment gets negative, all of a sudden then there's a reaction to revising estimates. These are earnings estimates. We're reacting. When the market changes and you own the index and a bunch of average quality businesses and you start to get scared, you need to react, right? But then often when you feel a little bit better, all of a sudden you ease up, right? But did these businesses change? No, sentiment was swinging around. Even with higher quality, predictable businesses, things didn't change that much, even in that short period, right? Even the estimates, and these aren't our own estimates, these are third-party estimates. They looked at our business in aggregate. They looked at the index businesses in aggregate. And with the environment changing as it was, I'm already showing you more deeply into this previous slide. It's telling you, all right, if things are getting bad, now here the market changed its mind quickly that they were going to continue to get worse, but it's going to have to revalue. It's going to have to revalue and readjust its earnings for the index. Us, much less so, right? So put that together with the previous slide and you start to get a bit of a picture. Debt, a lot is talked about debt. Strong balance sheets are an attribute and a quality we clearly look for. We show you here, marginally, we are in aggregate looking better, but the key is one step deeper with the index, right? We have a better debt profile, but once again, we have much different companies too. So while the index might look like it's all right from a debt perspective, understand too, These are an aggregate of a lot of cyclical businesses, a lot of businesses that won't have enduring structural growth. And as you know, with banks, leverage doesn't kill a bank, liquidity kills a bank in the end, right? How does a bank run work? Very slowly, and then all of a sudden, right? And this is a similar dynamic here I would be leery of with the index too as well. That's a little bit misleading. It's when cyclical pressures come, cash flow deteriorates, that these ratings then start to drop. We know what happened into the financial crisis. Ratings were great. No document, no income mortgages were AAA, right? Then all of a sudden when the cash flow went away because they were no income, no documentation, the ratings dropped. So we're seeing this pattern once again a little bit. You know, we look better, yet too similar to an index that's quite different with inherently a lot more risk underlying it. Also, last point here too as well, let's understand where this leverage has come from, by and large in the market. We hear it every day. Share buybacks, share buybacks, share buybacks. It's one thing as a business to take on debt to do something productive. Buy an asset, the asset delivers cash flow. Build an asset. Borrow, build, cash flow. Service debt. A lot of this leveraging, as we know, has been put to use in what could end up being rather unproductive propositions, right? You bought back shares, you reduce earnings per share, but earnings per share is not going to pay the debt when the debt comes due. There's been a lack of purchase of productive assets. So here, philosophically, to give a sense, what do we avoid with quality? What do we focus on, right? We talk about high quality, predictable. What do I mean by predictability and less cyclicality? We give you an example of two companies, right? We love using these two examples. This is back to the financial crisis once again, I think, because it gives you a vivid illustration of what happens. This is Toll Brothers. This is a home builder in the U.S., right? They just reported actually disappointing earnings recently again, but this was a darling for a long period of time. Home building was booming for years in the U.S. They looked cyclical over structural. People start, well, this is a structurally good industry. It's booming. Look at the dynamic. Everybody starts to figure out people need houses. People need more houses. There's always reasons to why something isn't cyclical and it's structural. But it's a home builder, right? It's a cyclical business. Let's step back with some common sense, right? This is a home builder. This is a big purchase. It's tied to interest rates, but everybody wasn't worried about that. And even these are consensus estimates, right? The blue chart is the consensus estimates. So all the smartest of the smart, not dumb people, smart people talk to the company a lot, follow the company, model the company, react every day, every quarter to what's going on in the company. They thought this business would continue to earn $2, $4, $6, right? Heading into the crisis. Didn't see anything coming, right? As crisis starts to hit, slow revision. It's not going to be bad. It's not going to be bad. Not going to be bad. Here's what actually happened to earnings, right? These are actual earnings, right? And my point here isn't to disparage, the people predicting it. I'm just saying they have an impossible task. So we look at investors and say, let's not try to accomplish the impossible task. Let's not try to buy businesses that you just can't predict. And even smart people can't predict these businesses, right? So let's just not indulge ourselves. Let's focus on businesses we can understand, right? And it's not always about the rate of growth, it's about the predictability of the growth. We also look for attractive rates of growth. But the simple example of Coca-Cola, it's just much easier to predict what's going to happen. And in order to be right when you invest, you at least got to get that close. You don't have to be precise, but you got to be in the right ballpark. So at least with Coca-Cola, as you see, particularly through the crisis too, yes, things slowed down, but at least what people thought would happen was fairly close to what happened. If you don't have this, there's no way to value a business at the end of the day. This is impossible to value this business. If you have some certainty as a foundation, valuation also becomes much easier. So where does this come into practice? In companies, to get closer and closer to the portfolio. No, United Healthcare, Thomas pointed it out, one of the largest health insurers in the U.S. Health insurance is a pretty good business. People need it. Got to have it. Right? Whether it's provided for you or you have to purchase it, it's one of those got to have things. And if you don't have it, you want it and are trying to get it. Right? Basic principles, right? About half this business is traditional health insurance, yes. Some of that business, you sell insurance to businesses which can be a little bit more cyclical, but structural. You can eat market share. There's reasons you can grow if you're the best operator in the space. But the other part of that business of insurance is selling administrative services to the government, right? And there's a lot of things we can often do better than the government. In the private sector, they administer a lot of the Medicare and Medicaid government programs, which is structurally growing. The government and the aging population is outsourcing more and more of that work to the high-quality, best operators like United Healthcare, who are providing real value added and service to their customers. Structural growth in a predictable business there. The other half of the business, structural growth, is more of a technology-oriented business around data management, trying to deliver better health outcomes based on a research and a data analysis of the past, more value for money in healthcare. All the classic problems we're facing now. How to deliver more healthcare to more people, more healthcare with lower cost, how to deliver healthcare with better outcomes. United Healthcare is by far the leader in this, to the point that they have half a business that not only just gives us data you'd think to their own insurance company, the other insurance companies want it too and buy it too, that are competing with them on the other half of the business, right? Structural, low double-digit growers. So that's where you get growth. You get more growth in a great, predictable, high barrier to entry business, and you also get a stable base. On the other hand, albeit with slightly lower growth. And in aggregate, what do you get? You get about 12 to 15% a year earnings growth, fairly predictable at around 15 times earnings. Great value, right? The key here too, look at the estimates, not moving. People panicked, not moving. We like a rock. People understand the business isn't changing. Now, what could be a great opportunity here further? So we own it, it's doing well, we think it's undervalued already. Look, sometimes markets and volatility do give us greater opportunities, and we got one coming our way in the US right now, right? The election cycle in the US. A lot of talk about healthcare, a lot of talk about, ideas about massive transformation. Bernie Sanders and the far left, we just rip out what we have in the US and we go all in on single payer systems. A lot of ideas. I say politicians like to deliver ideas, but they're often not practical, right? Or probable. It's exciting to talk about, but there will be pressure further on this stock, but we're ready. We're willing to buy more if the stock goes down, right? Because we have conviction in the fundamentals of the business coming through. It's not just in the US, around the world, right? In the global portfolio, even in France, right? Great businesses. This is an industrial company. So a lot of people would say, staples, I get it. Healthcare, I get it. Roll up your sleeves, have a philosophy and a mindset. We look everywhere. We find less quality in a lot of places, but we look everywhere. This is an industrial. Industrials sounds cyclical, sounds capital intensive, right? But in the industrial space, you can find a business like Safran that makes aircraft engines. Might also sound a little bit heavy, cyclical, but it's not. In that you have very long visible pipelines of aircraft manufacturing production, right? Which can't even meet current demands out several years. And the great thing about the industry is you only have a couple of players. It's a highly consolidated industry. So you start to look at the building blocks. So why are the returns in this business so strong? Well, it's highly consolidated, not much competition, right? Two main competitors, GE and Rolls-Royce, and Safran works on a number of projects with GE. So very consolidated industry. The greatest part about it too is we like predictability. So it isn't just about new aircraft being built. The key to this business is you sell an engine, and sometimes government regulation is good. Right? When we get on an airplane, we like regulation. Right? When we go to the grocery store and we try to pick a banana, maybe we don't want government regulation about how big the banana is or insignificant issues in life. Right? But when it comes to when you get on things like an airplane, you like to know that the government regulates and tells the airline how often they need to service the engine, how often they need to overhaul the engine. So whenever you sell an engine, you lock in your revenue stream, your growing revenue stream over the life of that engine, which is long. These are long-tailed assets you sell to your customer. Razor blade, right? This is what we like, even in an industrial, that predictability, that ability to forecast. We know the engines are out there, and we know how often they need to be maintained. We can calculate, we can predict that, and have high degree of comfort we'll be right. This is where quality manifests into individual names. This is where, when you peel back the onion, you separate cyclical from structural. Thomas pointed this out, which is key, right? In aggregate, you buy Safran, you buy United Health. In aggregate, you get a portfolio like this. And critically, as Thomas pointed out, then look, if things get really bad or if things get worse, whatever margin economic cycles change, at least our businesses keep pushing earnings positive collectively, right? That's how you preserve capital. Stock prices are transient. If the business goes out of business, that's permanent, right? If the business survives, and not only survives, but continues to grow through the difficult economic cycle, that's how you preserve capital, and that's where you take advantage of a stock price that's weak. Right? If you have a stock price that's weak and the business could go out of business, it's taking advantage of you, right? You might be the last buyer of that business. If the business is strong and durable and predictable and the stock is down, you're taking advantage of the marketplace and the stock market. And cumulatively, that has a very powerful long-term effect. So the last slide, and then I'll just quickly show the portfolio and make sure we get to any questions. ESG, very topical, more and more topical. The key point I want to leave you here is this. ESG is important to us. Right? What's most important to us is preserving and compounding capital. Now, people don't come to us, primarily because they want to save the world, right? Or they want to institute change. We're in the investment business. They come primarily to us because we want us to preserve their capital and compound their capital. Now, that's not incompatible with achieving goals and being responsible from an ESG perspective, but we're not going to lead you with ESG and say we're going to go look for things that are doing good and then deal with that to hopefully get some decent economic or investment returns, right? There's no sustainability if you're not profitable over time. You can pay your employees a lot of money or overpay them, but if you're not around to survive, your employees will also not have jobs. You can go through all the elements of it. We want to start first with great businesses and with real profitability, real sustainable profitability, and then through the research process, when we evaluate the business, try to figure out what makes it strong. Why is its growth predictable? Why can it continue to grow? Make sure it's doing that in ways that are consistent, and these aren't incompatible goals. Your governance standards have to be, generally, very good businesses have very good governance, right? They can go hand in hand, but start with the good business, right? Environmentally, right? We don't buy cyclical businesses, And most energy-intensive businesses, oil producers, commodity producers, it's extremely cyclical. We just don't own them because we're looking for economic returns, and that makes us look like we're doing very well for the environment, right? So you can feel good about that too as well, but the primary goal is the capital, is the economic return, but also by doing that, you can get a very good byproduct, right, of strong ESG metrics on things like environment. We think social issues, ethical issues, they reside with our asset owners, the client, right? They make the considerations based on who they are, where they are, maybe with their framework, what they will or won't be able to tolerate from certain absolute perspective. No tobacco, sometimes now growing a little, no coal. We listen to that. It's not my part to imply my lens to my clients. My clients tell us, based if we're in Australia, we're in Italy, these are our considerations, right? And we let you know, is that compatible with what we can do for you from an investment perspective? And sometimes it is, sometimes it isn't. Sometimes it just isn't a good fit, right? But that is where the decision, I think, should be made. It's not by us to make that decision for our clients through our lens. And that's just a little bit of a sense of the essence of philosophically how we view ESG. We can accomplish and have strong ESG scores, but you have to lead with looking for great business and great economics. Very quickly, the portfolio positioning, and then maybe it spurs some questions. So what does this look on aggregate, all these things we've talked about? The global equity strategy. Look, we own a lot of consumer staples. Traditionally, I think that probably makes a lot of sense. Then you get to this next one I always point out in a global equity portfolio, consumer discretionary, right? Discretionary in English, and the translation, I'm sure, and definition in Italian is the same. It sounds like something you have a choice. It's discretionary, right? You have a choice to do it. Well, even within discretionary, we can try to find things that aren't so much of a choice, right? Even though it's labeled in this category, roll up our sleeves, dig deeply. One prime example, it's always difficult to use this example in Italy because you have such good coffee and such cheap priced good coffee, but Starbucks, right? Most everywhere else in the world, particularly in the US, even in China now, Starbucks. Coffee, you don't wake up in the morning, I don't think many, but it's like, well, will I have a coffee today or not? You either drink coffee or you don't. And when you do drink coffee, you probably drink it regularly, right? But that's a discretionary. But we can find something that has the attributes that's fairly predictable, right? And then has branding, right? Then has opportunity of growth in places like China, or in diversifying their menu in the US and inventing and trying out different drinks, right? So discretionary, we can dig deeper. Technology, too, as well. Look, we don't buy the Ubers, we don't buy the Lyfts, we buy Visas, MasterCards, right? I know every one of you today, most likely, most everyone in this room at some point today might swipe a Visa or a MasterCard credit card, just like the day before and just like tomorrow. It's a great global duopoly, oligopoly if you include American Express, but it's a different system, right? So we like that in technology. We don't need to predict who's going to invent the self-driving car, the flying car, we don't have to figure out who's going to win, when Uber will start making money, who will win Uber or Lyft. There's a lot easier ways to make money. And Visa and MasterCard are growing earnings 15% plus a year. So we can buy maturity, we can buy quality, and we don't have to suffer principles either. And we find where there's that alignment, where we're not sacrificing one to get the other. And you see, look, ideas, we are active. This is the last 12 months to give you some wider perspective of where we're active. We can find diversity still in quality in a variety of industries, in healthcare, in staples, right? In industrials, in healthcare. It's abundant, but it's not always obvious. You got to roll up your sleeves. You have to dig a little bit deeper. But the same thing, although these businesses are across different industries, the same things they have to hold true is this quality aspect, the predictability aspect. That's what we're looking for. We're not targeting top-down, more staples, more this, more that. We're targeting bottom-up quality. It just leads to pictures like this. One thing I want to show you before we get to close is emerging markets, which is one slight difference, right? Thomas mentioned earlier quality in developed markets global, he showed you, tends to be a bit more mega cap. Right? When you go to emerging markets, it's not that we're a mega cap manager, it's just that now in particular and historically, you find a little bit more quality in bigger companies in the developed markets. Not always, we're willing to buy any cap, we're all cap, but it's just where you often find it a little bit more. In emerging markets, the cap range typically comes down a little bit because the big companies in emerging markets, of which you own typically a lot of in the index, right, tend to be lower quality cyclical businesses, Chinese banks, energy companies. It's just the foundation of these markets, right? Here's where we look a little bit different, financials in emerging markets. So you think, in our lens in Italy and the US, we think financials, where's the growth, right? And it's different. It's very different in the developed markets than emerging markets in the area of financials. You can find predictable, sustainable businesses in financials in emerging markets for a couple basic reasons, right? One, demand and structural growth from consumption, right? People with no checking accounts, no saving accounts, no mortgages, no auto loans, right? Younger population growing into it. So I'm an older generation not even having these products and now earning more and being able to have these products or need these products, let alone a younger generation. Then on top of that, when you get into the emerging markets, there can be a big difference within a sector that's growing between quality in that a lot of these countries, take India for example, the public sector dominates the space, right? Still government shareholder controlled companies that have been around forever with lower quality management, more bloated or poor loan books because of more directed lending historically, less available capital to freely lend, poorer service quality, poorer motivated employees. They control 70% of the market in India, right? 10% of this exposure is to financials in India, HDFC Finance and HDFC Bank. They're private sector operators, single-digit market share, better management, much better capitalized. Every year the pie grows, the financial pie grows, whether India grows 6% or 7% or 8% or 5%, the pie is still growing, and they're just eating market share. Structural visible growth. Right? Better business, better quality, better mousetrap to capture market share. That's why in emerging markets, financials, it's not as dirty of the synonymous word you think about with cyclicality if you can find structural versus cyclical. Our Indian banks aren't just growing because the economy is growing, they're growing more largely because of this dynamic I explained. They are competing against banks who have two hands tied behind their back. It's just not fair competition. So that's just to give you a little color there. As I said too, a wide variety. It's not just in financials. New idea generation comes across a variety of names. Gambling, right? Retailing, alcohol and spirits, a whole host of opportunities. Same qualities, quality, predictability, growth. And with that, to leave you with that flavor, if I just close with one quick reminder, and make sure we cover any questions you might have. This, philosophically, what do we wake up every day thinking about on our team? What do we stress day to day, week to week? Protect capital, compound capital, but don't sacrifice number one to get to number two. And the way you do that is you avoid cyclicality, you focus on structural growth and predictability. Thank you for your time.
Grazie.
Thank you, Matt.
Thank you, Thomas. C'è un sacco di domande, eh?
I have plenty of questions. You were very active in asking them, and we'll also leave the floor to you later.
Come la nostra
We saw how our choice is in favor of an active management, and we said we'll take the risk versus the benchmark. We won't let the risk to customers. And this is very important because when people give us their money, they also give us their ability to buy in the future, to be protected in the future. I'd like to illustrate how this strategy works and has been working over time. Over the next chart, you see bubbles, different colors, and green shows the annualized performance over a period of time when it is above the benchmark. Yellow when the performance versus the benchmark is lower, up to 2%, and red if the annualized relative performance versus the benchmark is lower than 2%. Having a look at all our strategies, since inception, we get this chart. This shows you how every year, after 1 year, 3 years, and 5 and 10 years, and since inception, these strategies performed versus the reference benchmark. As Thomas anticipated, to win in the long run doesn't mean to win every single battle, every single frame. There are times when the strategy might underperform, but the philosophy, the investment approach is so much tested that every single time I meet with them, I ask them, are you happy? Because if they are happy and they work well, they'll bring us performance, and outstanding performance at that. Now, two clarifications. This chart was prepared based on the funds and the retail asset class. This is what the customer gets after underwriting a sub-fund. This is the yield, the return the customer would get. And here you see annualized performance. And if annualized, the performance has a specific impact. But you have a look in total, it is outstanding. Emerging markets, an outstanding performance. Asia, for instance, Europe, global equity, 239 as against 135. So what I'd like to underline here is that, as you all know well, one of the most difficult markets to beat is the U.S. equity market. S&P 500, many professional managers, institutional managers moved from a passive approach to an active one because it is difficult to beat the S&P 500, so you just surf the beta. If we have a look at the fund, our fund performance, and this brings me to the interest of the compounded return, and you see that our fund performed on an annualized basis of 1 + 1 3. This means 1,715 as against 1,271. So if this customer had invested 100,000 euro in S&P 500 or in our sub-fund, would have 1.7 million as against 1.2 million, 500,000 euro more. That's why
Thank you very much. I soldi dei miei figli e i miei sono investiti.
My money and my children's money are all invested there. I'll be very frank and honest about this to tell you how confident we are about this trade, about this strategy.
I do it It's better I do in English or you? Yes, I do in English. So, the trade war, guerra dei dazi USA contro Cina penalizza anche l'Europa. Has an impact on Europe too? This is the first question. And the second one is, le politiche monetarie, BCE, aumento dei tassi, o Fed.
The monetary policy of the ECB, whether this can bring to a postponement of the decision.
ECB is increasing rates for you, and Fed is lowering the rates. Can this postpone the recession?
So for two separate questions. First, I'm a little jealous Matteo gets to speak so quickly. That's usually my English. Now you're getting me to see, this is the slowest I've ever spoken for this long, so I'll try to keep it up. The trade war, look, as I mentioned, the trade war to me isn't a deal. It's not about a deal, it's about a change in relationships. And I think certainly why the U.S. has led this initiative, I think, for some misguided, but some rightfully guided reasons, the U.S. rightfully thinks they're more insulated, right, from the issue. So you asked the proper question than Europe. I think Europe's definitely caught much more in the middle, right, and not yet engaged in the process from the U.S.'s own fault, quite frankly, and from a policy perspective, the president has chosen to go this alone. So while I wouldn't criticize their fault, what the goal is, the approach, I think a lot of people have a criticism for. That's what differs about China in the U.S., just the approach, not actually the end goal. So doing something with Europe probably from an approach perspective would have been much better. But that being said, that's why your question is important, because Europe has yet to deal with it yet, right? And the U.S. is talking about trade relations with Europe, and I think something there will probably work out because it's not as incompatible of the goals that China has, I think, as a country and what it's trying to achieve versus what the rest of the developed world wants for them. So Europe, I think, yes, the impact is yet to come, certainly from the trade war. I think there's other offsets. I think we all, the U.S. and Europe, have other opportunities. So China is important, and it is important right now, but we have the Trans-Pacific Partnership, what the U.S. isn't a part of, but other countries are a part of, right? There's emerging markets outside of China, right? That's an important reminder, too. And when we look at our portfolio, everybody, when we think emerging markets, we do think China, and partly it's my own fault, too, and all of our fault, because we think about China first, China's issue. But it's not China. It's India, it's Indonesia, it's Malaysia, it's Thailand, right? It's Latin America, it's Brazil, Mexico, right? So there's a lot of other things. Look, China trade is coming under pressure. Mexican trade can pick up for the U.S., right? And for Europe, I think that's what my answer would be to that. Europe has yet to face it. Europe will be caught definitely more in between than the U.S. because of the current trade relations with Europe. But I think it's still very manageable in Europe, like the U.S. plays with still a bit of a stronger hand. I think we all sit on the right side of things, and there's definitely other opportunities in emerging markets, I think, to navigate it for Europe. And the question will be just how that actually happens in application. In theory, it's solvable. In application, which we would never bet on, but we'll have to see how that comes out. On monetary policy, look, I can't forecast it any better than anyone. But when I look at the market in the U.S., there's this big focus on, inflation and that driving interest rate changes in the U.S. And, as they say, people often have a view and the view's wrong forever, so then they change their mind, but maybe they just didn't hold out long enough. And I think that's the issue with inflation in the U.S. The indicators I didn't put in this presentation here, but the indicators are, and you can see from a common sense perspective that wage inflation is picking up in the U.S. It's a tight labor market. Immigration has been constricted. Demographically has worked against it. So labor market pressures are picking up. So I don't think inflation has been taken off the table in the U.S. like everybody has switched from the fourth quarter to the first quarter of this year. I do think the U.S., when you think about the events that might change or knock the U.S. into recession yet, I wouldn't take the Fed off the table in terms of reducing interest rates now. I think they could still hike interest rates, certainly, because inflation has not gone away, really, as an issue, right? And even at 2%, let's argue, that's why middle classes have been hollowed out. 2% is a pretty decent, 1.5%, 2%, if you're not getting real wage growth, you're still eroding that base, right? And that's why we have these political tensions, obviously. But I think you can get much higher inflation still yet because you're getting better wage growth coming through. That's affecting companies, and that's the risk with corporate profitability in the U.S. So one last point, you can have good GDP growth in the U.S. Maybe you don't have a recession in the U.S. in a year or 2 years. Maybe GDP goes to 1.5%, 2% in the U.S., right? The key, though, as investors isn't that even, it's corporate profit growth. So at that same point in time, you're getting that positive GDP growth and no recession. What I would be concerned about, and I am as an investor, would be how does that translate into profit growth? And if you're getting wage inflation there, still that hurts profit growth, that hurts stock returns. So I'm not giving you opinion on the US Fed, but I'm saying I'm not consensus there, and I think it's naturally down from here, for where your question came from. It still could be up, and at least it could hold for quite some time, because I don't think the Fed is crazy. I think they see what I'm talking about, certainly, and they're just trying to navigate that the best they can. They're trying to land the plane. And the ECB, I think, is certainly in a much more difficult position. One, you're going to have a change in ECB head, right, which is important, but the firepower just isn't as available. I think the key for Europe, though, the good news, it isn't about monetary policy changes. So Europe, the fixes have to be more political and fiscal. So that's the good news. I don't think Europe has visibly, it's not a surprise to tell you, room on monetary policy. But Europe has a lot of things I think that everybody is pointing to that needs to be done more on the fiscal side and on the political side, and that's good news there, I think. That will have to compensate, hopefully, for a lack of monetary firepower.
Hai risposto anche, c'era un po' di domande appunto sulla politica dei... Sì, there were.
You already answered some questions on the Fed interest rates.
Then
It's all tied together, right? I think what I say about the dollar, to at least give you something that's, it's my view, and it actually happens to be different. I think we're different on the investing side, and my view on the dollar is this dollar strength, I think, is artificial in a lot of ways, right? Interest rates are higher, and naturally some money in developed markets should gravitate where there's higher interest rates, and some flight to safety should come in. But that's where I don't have as strong of a view on a strong dollar, in that the U.S. has serious fiscal challenges. I'm giving you glass half full. U.S. has room on monetary policy, glass half empty. The U.S. doesn't have a lot of fiscal room. The U.S. is running trillion-dollar deficits, near $1 trillion, soon to be, during a strong part of the economic cycle. Typically, that doesn't bode well for a currency, right? If the U.S. did not print dollars, it would be a banana republic. Essentially, twin deficits, twin current account deficit, twin fiscal deficit, that's death in emerging markets, particularly when you're leveraged or have foreign currency debt, right? So if we look at the fundamentals, the U.S. would essentially be a banana republic if not for that. If you look at it in that conventional sense, the good news is the U.S. print dollars, right? But that's why I say on the dollar, with that reality, that economic reality, the problem is, for what I'm saying happening, the dollar weakening, is currencies are a battle of the losers. I mean, and I think that's why there's been such a fixation with cryptocurrencies. Everybody's looking for something. You don't want euro, you don't want dollar, you don't want pound, right? But currencies are all just relative to each other. It's a measurement relative to each other, and I don't think we really know where we want to go. We're trying to pick a slightly worse loser every day in a way, right? So the key, I think, to the dollar, I think at the end of the day, will be emerging markets, right? So if the Fed at least does not, if the Fed is in some sort of pause now, or gradual increase, if the Fed is just not extreme in a number of ways, given the fiscal challenges in the U.S., and if emerging markets, not just China, as I said, but emerging markets in general can grow and continue to grow, there should be room for emerging markets currencies. So they have to be the yin to the yang to some effect, because it's less obviously going to be the EU or the pound in the near term. So when I look at the dollar, I'd look more about the health of emerging markets. If emerging markets can continue to recover off this low, a number of them are able to stimulate now because the pressure is off from the Fed, right? And you get good growth there. I think that's what should naturally, when people look at the fiscal situation and the opportunity in the U.S. versus emerging markets, maybe lead to some dollar weakness.
there is a question that is a political question.
That's my favorite.
Yeah. No, the question is, I try to translate, there is approaching the election in 2020, there should be the power to have a very positive market environment to go at the election, or on the opposite side, they could create some conflict in order to have a very charismatic person then, after the crisis, solve all the problem. So from which hypothesis do you?
Yeah, I think negative, Dev, more so. You know, I think elections are generally messy. They're generally periods of uncertainty, particularly when there's no obvious, clear winner. We see that everywhere. So I'm not predicting anything. I'm stating once again the obvious. Whether it's in emerging markets or developed markets, elections cause uncertainty, particularly now when the world's become more polarized and the way an election goes swings ideology so much on this spectrum. Unfortunately, it used to be not much difference. Different flavor of the same ice cream, more or less. Democrats and Republicans used to be more or less the same, right? The parties used to be more or less the same. Now, because the election outcomes are more divergent, clearly, ideologically, anytime you come into that situation, no matter how much confidence you have in the outcome, right, still there's going to be more uncertainty, because if it just doesn't go that way, the difference can be that drastic. You saw it in Brazil. The good news in emerging markets is you're largely through all the elections, India imminently in any day. And India too, classic example in India, actually those parties aren't that different in India. You know, generally the market wanted Modi to continue and his party to continue because he's been on this push of reform, right? Some of the reforms he's instituted were actually originally, recommended by his opposing party, the Congress Party there. So both parties had good economic records and largely similar policies at the end of the day. Yet, with that uncertainty, the Indian market was under pressure just because it was an election. So that's the example. So I think the U.S., to your question, I wouldn't be optimistic that going into the election it spurs optimism in general. It would be a little bit nutty for that to do, even if you have a lot of confidence, just because you don't know. And particularly when you look at the landscape in the U.S. and the polarization, when you have so many candidates on the left side right now, and you saw how unpredictable that led to an outcome on the right side in this last election. Nobody thought Donald Trump would win. From the beginning, not even Donald Trump thought he would win, still before he won, right? You have that same uncertainty even on the opposition side right now. So I don't think the election coming in the U.S. will get people excited. I think it's more likely to depress people until you get a resolution. Then the market can price things in.
Abbiamo anche tempo per c'era una domanda. There was a question on ESG approach, but we covered during the presentation. Se ci sono domande anche.
If you have questions that you just came up with during our talk, you're welcome to ask them now. Please.
Strutturale rispetto a un investimento di carattere ciclico.
The difference between structural growth and cyclical growth.
Yep.
It was very interesting to hear this distinction between cyclical and structural, and I think we've learned a lot from your CEO when you said that your time horizon is 1 century. I think that's a very, very good idea, time horizon in picking up the right companies to invest in. So my question is, if I look at a company, how can I understand whether that company has cyclical growth versus structural growth? Thank you.
Differentiate when we see a company if it's a structural growth or cyclical growth.
Yeah, it sounds like it's, extremely hard. I would say the reason most people don't, not because it's hard or the methodology to do it is there, it's just because they don't want to. They want to sacrifice one for two. They want higher growth and they overlook the obvious. The way we can identify is just rolling up our sleeves and looking for the obvious and having a healthy skepticism and appreciation, looking at a longer-term past, right, than just a shorter-term past. Understand more full-cycle performance of businesses, right? Understand the underlying dynamics of a business, what the competitive dynamics are. Is it a market opportunity story? Is it a consumption growth story? If you break down very fundamentally the drivers of the business and critically you have an open mind and not a bias, and a bias can be index-driven, right? A bias, it's not that some people or active managers might not even want to take the time, want to roll up their sleeves. They just have to look like the benchmark, reasonably too. So then you start to overlook that. Then you start to make sacrifice. So you could be in an institutional framework that doesn't allow you to be open-minded. Because we are so open in our framework and agnostic and have wide parameters of bands of freedom, we really can step back and look at the basic characteristics of a business and with good old-fashioned fundamental research and an open mind determine what is structural and what's cyclical. And the past is usually a very good guide. It's not we have to make a wild prediction. As we say, the research process screens, then we understand the past before we even look at the future. And then we figure out if the future should look like the past. But until you can understand the past, in a lot of businesses we just don't buy because we can't understand the past. So that's another way too. If we just can't understand if it's structural or cyclical, there's a number of companies we just pass too. So it's only the ones where we can roll up our sleeves and really understand. That's where we move forward. And also we have, as Thomas mentioned on our team, investigative journalists too as well. So we have traditional financial analysts and 3 members of our team who aren't traditional financial analysts, they're former investigative journalists. And they work on what is our biggest weakness longer term. Every approach has a bit of a weakness, right? And ours, being very convicted, long-term holders, complacency is our biggest weakness often. You fall in love, and you don't start to notice. Maybe there's a change. Maybe it was structural, but it's become more cyclical. And we actually use members of our team deliberately to fight that, to constantly challenge. And those members of our team always look at things challenging and negatively. So in the onset for the research, we approach it, and then on a day-to-day basis, we're still always reevaluating. You have to constantly reevaluate too. It's never just determined at one point in time. You come to a conclusion, but then the reevaluation over time is also very, very important.
Sì.
Ci può essere, secondo lei, una specie di effetto time to market dato dai tweet del Presidente?
There can be a time to market effect by the Trump Twitter.
The time,
Yes.
the impact of tweet.
Yes.
Yeah. Well, what do I think about the impact? Or look, yeah, I mean, it's part of this VUCA world a bit, right? Well, this is a whole new dynamic, right? I mean, look, we live it day to day in the U.S. You live through your own politics a little bit day to day. We all are living through an experience in a way. In the UK, they've got their experience. As we say, we have different problems in life, but they're mainly similar at the end of the day. You've got your problems, I've got mine, but they're all in big buckets of categories. Work, family, health, all these things. And that's part of what we're trying to, I think, impossibly sensitize to in the U.S. This whole element of not social media sort of overlaps to Trump tweeting. And my point with this is just to tell you, even though we live through it, it's hard to get used to. Every day, it's such an activity every day. You wake up in the morning, you work all day you're working on fundamental investments, and then there's a tweet, and you try to make something out of logic. And by the end of the day, you maybe come to some conclusion of the why and what it means. And then by the morning, you have no idea again, right? Because it flips again. And I think the end result has been, and this would be my view, I told you 2 years ago from the beginning, the only way to kind of have some comfort is understand there is no logic in it. There is no brilliance in it. There's nothing you should stop to analyze. We'll all be whipped around by it. But it's like this is that painful experience every day. You just push the rock up the hill, you think you've got it, and it rolls back down again because it's just so unpredictable. And if you step back, you have to understand the nature of the person, right? And I'm trying not to criticize in a way. I'm not political in that way, but dealing with China, important. I think there's fairly large consensus, even in Europe, although it hasn't been dealt with yet. This is important. Here you have a communist country competing on an unfair playing field, right? It's hard. It was okay when they were smaller. When they were accepted into the WTO, I think a lot of us, in the West, we have good intentions. We thought over time things would get better and improve, democratize. They didn't say they would, but we thought that would happen, and eventually you sometimes have to reassess what's going on. So the act itself isn't crazy. He's crazy. The act itself isn't crazy. It's the methodology and the communication that gets a little bit overboard, right? So the clearest indication, too, is you can't look at the tweets, and this is glass half full, glass half empty. You got to look at the people around, too, to get a little bit more insight. And on trade, you actually get very good clarity as one example, because Robert Lighthizer, the chief trade negotiator, he's been very transparent. He's written a lot of papers historically. He's a very smart person, and he's got very clear goals and objectives. So you kind of got to ignore, if you can, the social media, but I'm telling you, you'll never get used to it. You try, right? And then you try to fundamentally look around at least for some clarity, because that's the only place you'll get clarity and comfort.
Bene. Allora, a me rimane che ringraziarvi per la vostra...
Very good. So all I have to do now is thank you for your time and invite us to join us for lunch. And I wish to thank both Thomas and Matt for their excellent presentations.
Thanks.